April 2027 is coming, and I'm seeing a pattern that concerns me. People are making decisions about their pensions based on incomplete information about how the new inheritance tax rules will work. Some of those decisions may create complications they didn't anticipate. My name is Gerald. I spent nearly 40 years working inside UK tax and pensions compliance. I've read the rules that HMRC publishes. I've sat with many people trying to understand what April 2027 means for their situation. Today I'm going to walk you through what's actually changing in April 2027, why moving your pension may not be necessary for many people, and 3 things you might want to consider doing instead. But I need to be clear up front. Nothing I say here is financial advice. I'm not a regulated advisor and I'm not your accountant. The rules are complex and your situation is unique. Before making any decisions about your pension, you should speak with a qualified independent financial advisor or PensionWise, the government's free guidance service. What follows is an explanation of how the rules work and things to consider. It's not a recommendation about what you should do. Let's start with April 2027 because that date is everywhere right now, and there's a lot of confusion about what it actually means. From the 6th of April next year, unused pension funds will be treated differently for inheritance tax purposes than they have been since 2015. Here's how the rules are changing. Currently, if you die with £300,000 in a pension and that pension passes to your children, it sits outside your taxable estate. From April 2027, those funds may be brought into your taxable estate. The rules allow some exceptions, particularly if the pension passes to a spouse or civil partner. But for other beneficiaries, the treatment changes. I've reviewed many cases where families thought they understood the April 2027 change and then discovered they'd misunderstood a key detail. Here's what the Treasury actually did. They changed the basic rule about pensions and inheritance tax, but they explicitly preserved something called the spousal exemption. If your pension passes to your spouse or civil partner, it may remain exempt from inheritance tax even after April 2027. That protection didn't go away. So before you consider making any changes to your pension, the first question is worth asking: who do I want the pension to pass to if I die? If the answer is your spouse, you may want to understand what that means for your situation before taking action. I've seen people make changes to their pensions in response to April 2027, when, given their specific circumstances, the change might not have affected them. That's why this matters. I want to walk you through some scenarios I've come across, because they show why this matters and why understanding the rules before making decisions is important. Scenario 1. Emergency tax on pension withdrawals. When you take a withdrawal from a pension before your provider has your current tax code, they apply what's called an emergency code. It assumes you'll take that same amount every month for the full tax year. So a one-off £50,000 withdrawal might be taxed as if you're taking £600,000 a year. The tax withheld could be substantial. While you may be entitled to a reclaim, the process takes time. Some people take this route thinking it helps with April 2027. But there may be other ways to achieve a similar outcome without triggering an immediate tax bill. For example, updating a death benefit nomination form, which costs nothing and takes about 20 minutes. Scenario 2. Pension transfer complications. Starting a pension transfer is a significant decision. It involves valuations, paperwork, scheme questions. Once you're in the process, stepping back can be complicated. Some people start transfers because they think April 2027 requires it. But if their goal was simply to change who inherits the pension, there may be simpler options. Scenario 3. Drawing pension after age 75. If you're over 75 and you inherit a pension, the beneficiary pays income tax at their own rate on withdrawals. That's already the case. Some people think April 2027 creates this problem. It doesn't. What April 2027 does is add an inheritance tax dimension on top of the income tax dimension that was already there. The pattern I've noticed is that people sometimes make changes based on a partial understanding of the April 2027 rule. The rule is real, and it does change things. But for many situations, particularly where pensions are passing to spouses, the impact may be much less dramatic than anticipated. That's why understanding the specific rules before taking action seems important. So what should you actually consider doing before April 2027? There are 3 things that might be worth looking at. All of them take minimal time. None of them require you to move your pension. Let me walk you through them. Move 1. Review your pension nomination form. 20 minutes. This is the one I'd suggest considering first. Your pension scheme should have something called a death benefit nomination form. Sometimes it's called an expression of wish. It's where you indicate who you'd like to receive the money if you die. Here's what matters for April 2027. The scheme trustees are not legally bound by this form. It's guidance, which is precisely why the payment itself isn't treated as a taxable transfer. That's been the mechanism for decades, and the rules preserve this mechanism even after April 2027. So, a pension with your spouse nominated as the beneficiary may remain exempt from inheritance tax after April 2027, provided it passes to them. You don't need to move the pension to achieve this. You just need to make sure the nomination form reflects who you actually want to receive the money. Many people have forms that are out of date, pointing to people who've passed away, ex-partners, or nobody in particular. If your form isn't current, the scheme will make its own decision about who gets the money. In the new inheritance tax landscape, you might want that decision to be intentional rather than by default. Here's what you could do. Contact your pension provider. Say, I'd like to review and potentially update my death benefit nomination form. Can you send me the form and explain the process? Most providers can handle this. You'll complete the form, indicating who you'd like to receive the benefits. You'll sign it and return it. 20 minutes, and you've clarified your position for the April 2027 change. Move 2. Understand your spouse's ISA allowance position. 10 minutes. This one applies if you're widowed and inherited an ISA. If your spouse died in the last 3 years and left you an ISA, you may be eligible for something called the Additional Permitted Subscription. It's a one-off extra ISA allowance equal to the value of their ISA at the date they died. So, if they left an ISA worth £60,000, you might be able to put an extra £60,000 into an ISA in a single tax year, beyond your normal allowance. It keeps money in a tax-free wrapper going forward. If you didn't know about this, it might be worth checking with your ISA provider. You could ask, my late spouse left me an ISA. Am I eligible for an additional permitted subscription? There is a deadline, 3 years from death or 180 days after estate administration finishes. After that, the allowance may be gone. Move 3. Consider having an estate planning conversation, 30 minutes. This is where you might want to talk to someone qualified. Not necessarily a regulated advisor, though that's an option, but someone who can help you think through how April 2027 might interact with your specific circumstances. You might ask, given that my pension will now potentially count toward inheritance tax from April 2027, does my current will and overall estate plan still make sense for what I want to happen? That conversation depends on your situation. How much is in your pension? Who do you want to leave it to? Are you married? Do you have children? What else is in your estate? All of these affect the picture. Pension-wise, the government's free guidance service can help with this conversation. The number is 080-0011-3797. It's completely free. They see hundreds of people asking exactly this question. A session might give you clarity on whether you need to make any changes at all. Before I finish, let me mention some approaches I've seen people take in response to April 2027 and why they might be worth thinking carefully about before implementing. Drawing your pension early. Some people consider drawing their pension early thinking it helps with inheritance tax, but this creates an immediate income tax position and reduces the size of what you eventually leave. You might want to consider whether the tax cost of drawing now is worth the inheritance tax benefit, if any. Moving your pension into a trust. Trusts used to be a common inheritance tax planning tool for pensions. The Treasury's technical notes on the April 2027 changes make clear that pensions held in trusts will generally still count toward inheritance tax. This avenue may not work the way people hoped. Moving into an ISA. ISAs are genuinely valuable for income tax purposes while you're alive, but when you die, the money inside an ISA still forms part of your estate. It's still counted for inheritance tax. The ISA wrapper gives you income tax protection for your lifetime, but not inheritance tax protection after death. That's a useful distinction to understand. The point is, before taking action in response to April 2027, it's worth understanding exactly how the change affects your situation. Otherwise, you might find yourself paying tax costs to achieve something the rules would have allowed anyway. Let me give you an example of how this might work out. Michael and Catherine are both 69. Michael has a SIPP with £240,000. Catherine has a workplace pension with £160,000, combined about £400,000 in pensions. Their house is worth £350,000. They have £80,000 in ISAs and £40,000 in savings. Total estate roughly £870,000. Michael heard about April 2027 and considered making changes to his pension. Catherine asked me, should he be doing something? The question I asked back was, who does he want to leave his pension to? The answer was his wife, Catherine. If Michael's pension passes to Catherine, the spousal exemption applies, whether we're talking today or after April 2027. His April 2027 concern may not actually require him to do anything. The only thing worth checking is his death benefit nomination form current and pointing to Catherine. If yes, he's probably fine. He didn't need to move anything. He didn't need to do anything elaborate. He just needed to understand the rule and make sure his paperwork reflected his wishes. That's the story I see repeatedly. Here's what I want you to take from this. April 2027 is coming. The rules around pensions and inheritance tax are changing. Those changes may affect your situation depending on who you want to leave your pension to and how much you have. But for many people, particularly those leaving pensions to a spouse, the change may not require immediate action. The three things to consider are straightforward. Review your death benefit nomination form. Check whether you're eligible for any additional permitted subscription if you're widowed. And consider having a conversation with someone qualified, either pension-wise or a regulated IFA, about whether your specific situation needs updating. None of these cost money. Together they take an hour. I need to be very clear. I'm a retired accountant sharing how the rules work. I'm not a regulated financial advisor. I'm not giving you advice about what you should do. The rules are complex. Your situation is unique. Before making any decisions about your pension, particularly any decisions involving moving money or restructuring, you should speak with someone qualified. A regulated independent financial advisor, an estate planning solicitor, or PensionWise on 0800 0113 797. It's free, it's government-backed. What I've tried to do today is explain how the rules work and highlight things you might want to think about. The decision about what to do is yours, and it's worth making with proper guidance. If this was useful, the subscribe button keeps it coming. I read every comment. The questions that come up most often become the next videos. Take care of yourselves and check the paperwork.